I think he was trying to underscore it's a long road ahead, but nevertheless, don't give up hope. The irony is going to be is that this is going to be both the sharpest as well as shortest recession, I think, in our nation's history. And so if the markets are forward-looking, the sort of return to some risk in the markets is not completely a surprise. I mean, I think some of the gains from here become harder, but nevertheless, I think the direction is positive and not unexpected.
Alli, do you agree with what Joe just said, that the gains from here may be a little bit harder? I do note that we're up almost 4% today for the Dow. We've come a long way in May, and the markets are moving ahead, it seems to me, on momentum as opposed to any clarity on what earnings might well be.
Yes, we have not had clarity for a very long time, and we seem to be getting more and more used to not having that clarity. I would say here, the market has been moving on momentum, on price momentum, around sort of progress in three areas. The first is drugs. We're seeing that today, whether it's inoculations or whether it's treatment. The second is progress on the virus. Are we seeing less cases? Are they less severe? Is it mutating? Third is, easing of economic and mobility restrictions, and we're seeing that a lot today too. So today what you're seeing is A, as Bob Pisani said, short covering, and B, price momentum following progress on two to three of those things. So, it makes sense that we have this going on, but I don't think it's sustainable. I think you've had basically 11 growth stocks that have taken all of the markets up. Again, they're not trading on the fundamentals. They're trading on very, very different metrics, and there's still so much uncertainty around them. The one thing that we haven't even talked about with regard to the virus, for example, is I saw a study this weekend that said because of the short-term nature of the virus and the testing, that about 35% of the population has said they will not try this inoculation. So, think of what that does if you have this sort of free rider and prisoner dilemma situation going through the markets and public health.
We're at session highs right now, Alli, but you say you favor credit over equity right here. Quick answer, why and what kind of credits?
Equity is pricing in the best case scenario here, which for myriad reasons is not something that I can get behind. Credit, however, is pricing in somewhere between sort of a downside second wave, maybe we haven't hit a low, and the base case scenario, which is that we keep on slowly going up from here. In terms of credit, I think there's still room to move in high yield. You have high yield energy markets pricing in somewhere between a 40 and 50% default rate. No way you're going to see that. Sovereign bonds issued in US dollars. That's a really interesting thing, especially with oil improving. I would stay short and stay in credit for sure.
Joe, I'm going to turn to you. I know this may not be sort of your sweet spot as the economist, global chief economist at Vanguard, but I've heard a lot of people come on our air in recent weeks and say, this is the time when you need to have a stock picker. That's what you need to do. You need to pick individual shares because there are going to be winners and there are going to be losers. Vanguard, obviously's bread and butter is the index fund. Tell me why an index fund makes sense right now as opposed maybe to having a stock picker do it for you.
Well, thanks, Tyler. In fact, I would say, first of all, I wouldn't, force to pick one over the other. I think there's a lot of talent and skill out there in the world. They just have to charge low cost for it. First of all, you want to be invested in the markets. If this is, for most investors, they have a long-term orientation. If you believe in any recovery in all of the next several years, you want to have your money invested in the markets despite the ups and downs. I think secondly is that if, there are skilled managers up there, I'm not a big fan, nor the research supports that managers, quite frankly, do better in some markets than in others. I think, though, you need to stick with managers, even a period of underperformance, because their outperformance tends to be lumpy. I mean, some years their trades go with them, sometimes they go against them, and in the long run, those managers that are skilled, outperform for a reason. So I think that's the bigger lesson is thinking about active managers that are low cost, that actually have conviction, and then stick with them yourselves.